Erik will provide insights for us today on what is ahead in the economy, for the economy in 2011. Please welcome Erik Ristuben. Erik.
Well, first of all, thank you all for inviting me. I'm delighted to be here today. And I think I am personally delighted, and I know the firm, Russell as a whole, is delighted to be now members of the Seattle community. And thank you all for the very warm welcome we've all received. I am going to talk about what's going on in the economy. I'm also going to talk about a little bit about what we think are likely outcomes for various markets around the world, various asset classes around the world, and hopefully if I do it right, I'll leave some time at the end for some questions if people have them. I always have to give a caveat at the beginning of any talk that I give that everybody has to recognize I am the son of an American history professor, and so I am genetically incapable of talking about what is about to happen or what might happen in the future without at least visiting briefly what's occurred so far. 2010. 2010 was obviously a year where there was a lot of concern on the behalf of a lot of people coming into the year. Mostly the wave of relief that we experienced collectively both in the economy and in the financial markets that the world did not in fact end in 2008 kind of carried us through some very strong capital market returns in 2009. Clearly we saw in the middle of 2009 the beginning of an economic recovery. The problem with the economic recovery that we've experienced thus far, and to give you a little bit of glimpse into the future, are likely to experience for the remainder of this economic cycle. The economic recovery that we've experienced thus far is, I think, fairly characterized as mediocre. It was an extraordinarily painful and devastating. The hype in the middle of the recession was that this was going to be the longest recession and the deepest and the most painful recession that we had experienced since the Great Depression. Unfortunately, it met every one of those criteria. It was the longest, it was the deepest, and it was the most painful. Normally, after such a profound recession, you would expect to see economic expansion occur at very high rates in a recovery. You'd be thinking in terms of real gross domestic product, real GDP growth for the 2 years following. If you did the kind of looked at the last few recessions, the post-war recessions, and projected the likely course of economic activity following that recession we experienced, you would have hoped to get 6 to 8% real growth rates in the economy in the next 2 years. This year is probably going to come in at about 2.7 in the U.S. That's not 6 to 8. And that is, in fact, the problem is that when you are experiencing such a mediocre recovery, there is going to be a lot of concern about its viability and its sustainability. And if anybody was watching the news, and I'm sure all of you are watching the news, you're all involved in business, and we're looking at the whole debate in 2010 was this whole notion of is risk on or is risk off, meaning is the recovery going to continue or are we going to a double-dip recession? Finally, at the end of the year, on August 27th, Ben Bernanke came out and said in a speech in Jackson Hole, Wyoming, that the Federal Reserve stood ready to do everything it could to maintain the economic recovery. Russell's position throughout the entire year was that we were likely going to continue a recovery at very modest levels. And in fact, what we were experiencing in the summer, which was scary, but was an economic slowdown. We had seen similar economic slowdowns at roughly the same time in the last two recoveries, both of which were jobless. So what happened in 2010, although it didn't play out exactly the way we expected, on balance, it actually played out the way we thought it might. Equity results were very strong in 2010, 16% on the Russell 1000. A 60-40 investor invested in 60% equities globally and 40% bonds globally would have had a return around 12%. Those are very good returns in 2010. As we look in 2011, it's interesting, in the last month or so, we've definitely seen we've seen stronger economic news. The consumer returned to the holiday spending, manufacturing numbers are up, and you see a lot of positive and improving economic news. And I think what's interesting is to watch the folks that do what we do for a living. A lot of them have become more and more bullish about what they expect out of the economy in 2011. We expect, I think the title of one of our key charts in our presentation is the U.S. economy making the world safe for mediocrity. And there's a lot of debate and there's a lot of focus on the U.S. And so if you look at kind of the general contract, we're expecting a 3% growth rate for the gross domestic product. That is, in fact, the long-term average, the long-term post-war average for the United States. So we are going to have, in our opinion, a remarkably average year, one that will feel hopefully a little different in terms of the violence of the market swings of 2010, but one that will actually be a growth rate very similar to the one we experienced this year. We don't see a huge number of real economic threats to that forecast. The threats we do see are policy error forecasts. And I'm going to talk a little bit about what might go wrong and talk a little bit about the nature of that recovery because I think it's important, and I think you've all heard a lot of this from other people, but I think it's important to collectively talk about what the expectations are. It is a very mediocre recovery, and one of the key components of this recovery is it's a jobless recovery. We have unemployment rates that are intolerably too high at the recent print was 9.4%. It went from 9.8% to 9.4% last week in the latest government data. And that sounds like a great thing until you realize the reason it went down was people quit looking for work rather than the fact that they actually found jobs. Only a little over 100,000 jobs were created last month. You need 150,000 roughly jobs created every month in the U.S. economy to simply onboard all the people graduating from college and all the people emigrating from other countries. And so you have a profound change in you have a big change in the unemployment rate. Our basic view is that it's going to take an inordinately and an extraordinarily painful amount of time for unemployment to get meaningfully better. And we've had a lot of people say, well, how can you say you're going to expect a 3% growth rate and you're going to have unemployment that's going to border on 10% for the entire year and not go down? How is that possible? Well, actually, there is an analog historically. The period from 1984 to 1986, the unemployment rate went from 7.7% to 7.2% over a 2+ year time horizon. And in that period of time, the growth rate in the U.S. economy was about 2.7% in real terms. So you can actually have this version of an expanding economy without jobs being created and still have good corporate profits and reasonable economic growth, even if that's not translating to jobs. And unfortunately, that's likely what we're going to experience. It doesn't seem likely that the Federal Reserve is going to meaningfully change its position to be very accommodative for the economy. Anybody who's been listening to Ben Bernanke for the last 4 months, he's been on message and on point. He's not changed. He's not stuttered. And frankly, he has been, for a Federal Reserve chairman, remarkably clear and understandable. You know, the famous quote from Greenspan was when the senator asked him under testimony, if I heard you correctly, Mr. Chairman, if I understand you correctly, Mr. Chairman, you said this, and Chairman Greenspan says, well, first of all, Senator, I would apologize if you actually understood what I said. That was a mistake on my part. So we're looking at a 3% U.S. equity growth rate in terms of economic growth rate, but as we just heard, the U.S. is not the world, right? We actually are less than 30% of the world's overall economy. Emerging markets, people talk about emerging markets in a lot of ways as, well, when they become important and if they become important. Emerging markets are important now. A third of economic activity in the world occurs in markets that we call emerging markets. The average growth rate in those emerging markets is 6% in real terms. A lot of that is geared to China, and China's growth rate is in and around 10% and is expected to stay there for the remainder of 2011. So you have you have the emerging markets growing at a 6.5%, 6+% rate. You have the U.S. at 3%. And you have Europe that Europe has a somewhat disappointing year, Europe will print a 1% GDP growth number, and if they have a great year, they will print a 1.5% GDP growth number. There isn't a lot of volatility in the European number, but that brings us to the number one thing we're worried about, is the Euro mess. We affectionately refer to it as the Euro mess. And when you think about the European the debt problem in Europe and the sovereign wealth problem, it becomes very concerning because As an economic problem, in terms of the size of the check, I mean, basically, people know roughly how big the check needs to be. And I think they actually even know who probably eventually is going to have to write the check to fix the system. It's probably going to be core Europe predominantly, probably the rest of us chipping in to make sure the system doesn't fail. That check is probably to kind of make sure that everything feels safe and addressed, and depositors in Spain and Ireland and Greece feel safe and secure. That number is probably around $2 trillion. That doesn't mean you're going to lose $2 trillion. That means you're going to put up $2 trillion. You'll get a recovery rate less than 100% on your money, but it won't be a $2 trillion bill. People pretty much know the check. Now what we're arguing about is who has to write it and when do they have to write it. Nobody wants to write it, and they want to wait as long as possible to write it. And it's become a political problem. It is going to be very difficult to convince a German citizen that they need to write a tax check to bail out a Greek worker who retired at the age of 50 and never paid income tax. That isn't going to go down well. And I think that is, and it is simply that tension that is the concern. There are a lot of difficulties, and there were a lot of difficulties in the initial construction of the euro. There were a lot of people that felt both as a political science exercise as well as a financial market exercise that it was doomed from the beginning. They have not yet been proven wrong, but so far they have been proven wrong. So we're worried about Europe. We don't believe this is the thing where rational people, as an economist, and I work with a lot of economists that are very, skilled and trained economists, and they always talk about the rational man, and you hope that the rational person makes decisions. Letting this actually go into free fall in Europe is bad. It is bad. The kind of the reasonable worst case scenario, if the policy errors occurred and were compounded, is you would have an environment that made what we experienced with Lehman Brothers seem very, very mild. Because you would have, instead of banks and financial services firms failing, you'd have countries failing, and the global markets beginning to pack hunt one country after the other, and eventually no one's strong enough to be able to survive. That is very, very unlikely to happen, because it is probable it will happen if people don't act. So I think there's a reasonable belief that people will act. But you do need to make sure, we do need to be aware that people are, in fact, saying all the right things, talking about the kinds of adjustments that they need to make, that they actually do commit some real money to this and actually decide that they will write the check when necessary. So that to scare you. The global equity contract actually is quite positive. Stocks are not expensive anywhere in the globe, nor are they particularly cheap. But there is a very good possibility, the 3% growth rate, that corporations both in the U.S. and outside the U.S. will be able to leverage that increased revenue stream into higher levels of profits, as they have done quite well over the last 4 years. They've actually managed profitability in terms of the global equity benchmarks very, very well throughout this entire recession. So there's an expectation that you have a chance for positive returns. We would say, think about a 1380 number on the S&P 500. That's slightly south of a 10% rate of return, high single digits. Not a bad year for equities. And again, policy errors being the most specific threat to that. Other things that are talked a lot about. There's a lot being talked about currencies, and the fact that every major currency in the world seems to be locked into a race to the bottom to see who can devalue quickest. People spend a lot of time in this country thinking about our very real fiscal and economic issues, and they start talking about the fact that we have a zero, overnight rate in terms of the Fed, an incredibly accommodative overall monetary and fiscal policy, and people are saying, well, at some point, shouldn't that affect the dollar? Shouldn't the dollar fall? The title of our section in our little report on that is "The Good, the Bad, and the Least Ugly." It is very likely that the U.S. dollar in 2011 will win the least ugly contest. When you think about its problems, but then you compare it to the euro, and we've talked a little bit about that, and you compare it to the pound, And the yen, which is probably at some point the economy probably they need a cheaper yen. They need a cheaper yen because they're an export-based economy. And at some point they will actually try to figure out exactly how to get a cheaper yen to actually address their economic growth issues. And so there's a very good chance that the dollar wins. We start talking about inflation. There's a lot of concern over inflation. Again, for all the reasons I just mentioned, we've printed lots of money. We have a very accommodative monetary policy. That seems to be the recipe for inflation. The challenge there, and we don't see inflation in the medium term. The challenge with inflation in this environment is that unemployment rates are very high, and industrial capacity utilization rates are very low. So there's a lot of excess capacity in the system, and historically it is very hard for inflation to take hold and actually become problematic unless you have tight employment and tight capacity utilization. Very, very difficult to actually get inflation seriously driving it. You've got commodities. A lot of people are very interested in commodities because of the emerging markets. Emerging market growth rates are very attractive. They are large incremental users of base commodities, agricultural goods. If you get some money in your pocket, one of the very first things you want to do is you want to eat better. You want higher proteins. You want better grains. You go to wheat. You go to higher end rice. You go to pork. You go to beef. All of that puts pressure overall economically on the demand function for commodities. And so there's this belief that there's this super cycle, not just because economies in the emerging markets are growing at 6+%, but if you think about the population sizes in terms of those economies, you're talking about a lot of people and a lot of mouths to feed and a lot of people who may want higher agricultural goods. You're also going to want more oil. You're going to want more input manufacturing metals. You see the whole secular trend, the 20-year kind of super cycle in support of commodities. And by the way, we actually agree with the super cycle. Where you're getting a lot of people getting very bullish in commodities right now, that makes us kind of wonder and concerned, is they're saying, well, commodities are a great buy in 2011, so you should overweight them and buy lots of commodities because of this super cycle. Well, plus the dollar's going to get hammered because everybody knows that. Well, a lot of people know that you can play the dollar weakness in commodities. So if dollar weakens, commodity prices will go up because a lot of these commodities are actually transacted in dollars, and the dollars are not worth as much. So you can win that way. And then the other thing is that you can buy commodities because there's going to be inflation. And so as an inflation hedge, commodities will be hugely attractive. Of those arguments, we believe 1 out of 3. We think that the hype around inflation and we think the hype around a weak dollar just aren't there to support commodities. So what we would say is that commodities make a lot of sense in a lot of people's portfolios from a strategic standpoint. But if you think it's a great tactical time to buy commodities, maybe not. Probably own them at policy. Going all in may or may not work for you in the coming year. Emerging markets are actually, in terms of stock markets, are relative to their historical norms, are actually reasonably expensive. In our business, richly priced is a euphemism for expensive, attractive is a euphemism for cheap, and fully priced is a euphemism for they're about right. So they're fully priced. They seem to be basically not too expensive, not too cheap, but relative to some of the kind of developed markets, actually emerging market stocks are actually more expensive on a relative basis than they historically have been. And that's because we've always discounted as investors emerging markets because we're worried about political risk, we're worried about financial market risk, we're worried about systematic stability, right, in these countries. Well, one of the things that's kind of an interesting thing for us to all note is that historically emerging markets have been more volatile, and one of the things that has been absolutely devastating to emerging markets in the past is if you have a massive global recession that was brought upon by a global financial crisis. Any of this sound familiar? That used to wipe out emerging market countries because they had no access to liquidity, no access to money, no access to capital, and basically because they could not get the liquidity in terms of the new funds required to keep their economy running, they collapsed. This time they didn't collapse. Actually, emerging markets came through this whole thing. The emerging financial services sector in emerging markets was actually stronger than in the developed markets. So I think that's maybe a reason to begin to think about, begin to start rethinking about how big of a discount are you going to apply to emerging markets for all of the incremental risks that you experience in emerging markets versus developed. I'm not saying they're all gone. I'm just saying it's an interesting thing to be thinking about. And then finally, on on real assets like infrastructure and real estate, those seem to also be reasonably fairly priced, although infrastructure, and for those of you that don't know what infrastructure is, there are companies out there that privately run prisons, companies out there that privately run airports, ports, highway systems. You kind of think of any kind of infrastructure project and they actually privatize those and run those on a private basis. That is a very common method to actually finance infrastructure projects in the emerging markets. I'm actually not certain that it won't be a significant way that we won't in the U.S. It may be the vehicle we use to actually rebuild some of our aged infrastructure rather than doing it on the public books, actually do a private-public partnership and an investment opportunity. You're seeing that trend in Europe and developed Europe as well. So infrastructure is an interesting area for the future, probably mostly because the massive populations that are coming online in the emerging markets. So collectively, we're actually we're reasonably bullish. We think we're going to have modest economic growth for the year. We think equities will have a reasonably good year. About 6 weeks ago, we were quite concerned about bonds because we thought it was very likely if people became more optimistic about the economy, that they'd begin to reflect that in bond yields with a little higher expectations for real rates of growth, maybe even a positive inflation expectation rather than a worry about deflation. But a lot of what we were concerned about has already happened. It's already in the cake. In December, November, December, the yields moved up pretty aggressively. The aggregate bond index was down 1.5% in December. And the 10-year yield was up 100 basis points. So we think probably about 40 or 50 basis points more to go this year. But that's not enough to really cause you to be worried about massive negative returns in bonds. We just think the returns in equities will probably be on the margin better on balance. With that, I think I do have a couple of minutes for questions, and I would ask people and encourage people to ask. Thank you.
Erik does have time. Now, remember the rules here. What you want to do is get the attention of somebody with a mic, because rather than try to identify people in the audience, we will identify floor mic people, and first go with Nancy and then over to Mark. Nancy.
Yes. If $2 trillion is the problem in Europe, how does that compare with the problem in the U.S. with Social Security, Medicare, and so forth?
It's significantly smaller. It's a much smaller number. Hopefully, the real issue is that those are real issues that need to be addressed, but they probably don't have to be fully addressed in the next 2 years. The $2 trillion number in Europe has to be addressed in the next 2 years. So it's not the size of the fiscal issues around Medicare in particular are much more profound than that. It's just the immediacy of the solution is we're not in an emergency situation yet, but we will be at some point.
Mark is over here.
Thank you very much. You're a good speaker with good content.
Well, thank you.
If your daughter might become chairman of the Fed or Treasury Secretary 30 years from now, and they're sitting around the table looking back at what happened in the first decade of this century, what would they be saying that we did right and did wrong in terms of both preventative and curing the problems that we've had?
All right. Well, I'll pick it up the easy one first, which is the Fed. That's, I think, the much easier one of the two. Fed, as it turns out, we made too much of Y2K. As it turns out, we didn't need that much liquidity because the world didn't end because of a decimal point error in every system, and I think that the concern over Y2K caused the Fed to be much more accommodative in the late 90s than they really wanted to be. They had, in the late 98, they had to respond to the Russian debt crisis and pump in a whole host of liquidity then. I think they would have naturally wanted to take some of that out of the system, but we're not really feeling comfortable to do that. And that left us with a glut, an asset bubble, and then we saw the whole thing. I think Ben Bernanke, in his handling of, since he's come on board, I don't think he's made a lot of mistakes. I think you can make a very reasonable argument that he may go down as the best Fed chairman ever. Now, he happened to be uniquely positioned for the job that he got because he was the leading academic scholar on what the Hoover administration and the early Roosevelt administration had done wrong in terms of monetary and fiscal policy in response to the Great Depression. So he was the leading academic in the world on that. He had written a book and basically the game plan as to what should one do differently if the events were to transpire in a similar fashion. And he ran the game plan he had, and it hasn't fixed everything, but it did work. We didn't experience the end of the world. We do have an economic recovery, have more stability, and we actually have a fighting chance at fixing some of the problems that were mentioned earlier. So I think they've done very well in general.
Over here.
Hi, I'm Mark Weed. We talked about the national problem. What about the state's problems? Because there are some real problems there about defaults that are being rumored.
Yeah, it's the state solvency at the state level is not clear at all. I mean, there's a lot of states that are upside down in terms of their tax revenue and receipts relative to their obligations, and in many cases, it doesn't look like it's going to get better in any short time, particularly with the high unemployment rates that we're experiencing. I think that you're going to see defaults at a municipal and a state level. I think that for the system stability standpoint, the federal government will continue to provide as much support for the overall system as it can so that those failures don't become catastrophic. And it's actually that ability, right? Because the federal government has done that. The initial stimulus bill was aimed directly at states and municipalities and not so much at the federal government. It was to allow states and municipalities to function in a reasonably normal way given the massive problems that they were facing. And I think that the federal government will continue to do that. And it's actually that ability of our federal government and interrelating with states that is a notable departure from the problem in Europe, right? In Europe, you have a federal monetary authority, but you have absolutely no political homogeneity. They're not homogeneous politically, and there's no fiscal ability to actually tax to solve some of these problems. And so, I was kind of telling my friends in Europe when they were saying, well, the euro isn't doomed. Everybody understands reasonable people would never make the kind of decisions you think. And I said, well, there's only one example in the history of the world of a multiple currency system aggregating into a central federal currency, and that's the United States. And it took us the bloodiest war in our history to actually make that happen. So it can get bad. But I think the ability of the federal government to continue to support states and stop it from getting too far out of control is likely to occur. But you're going to see defaults, and you're going to see restructuring of some of that debt. Checks are going to be written.
Continuing the historical perspective on the unification of the dollar, after World War II, we became the world's reserve currency, and we still are.
Yeah.
But that's sort of a historical accident. How much longer can we expect that to continue? What are some of the things that could cause it to change, and could it happen abruptly?
It could happen abruptly. I don't think anytime soon, though. Again, it's a little bit of you got to measure against the peer group, right? So the contenders right now are, the euro is really the only contender, and I don't think anybody's feeling like they want to run to the euro away from the dollar. So I don't think that's likely to happen. I'm not sure that's going to change in the not too distant future. I mean, obviously the Chinese yuan is the big currency that in the future will likely be the market will turn naturally to it as the reserve currency. China, I can assure you, at least as far as I can see, the next 2 decades has absolutely no interest in letting that happen. A yuan that isn't pegged to the dollar would strengthen dramatically and cause them serious economic growth problems in China. And China has China's whole economic revitalization and revolution is based on a political issue, which is based on a demographic problem. They have to make their workers massively more productive. The only way they can actually have a shot at being able to outrun their demographic problem right now is to take an agrarian-based, subsistence farming-based economy into an industrialized economy as fast as you can. It's the only way to increase the productivity of the very small number of young workers that you have relative to your older population. They cannot, the experts believe that China cannot let its real growth rate fall below 7.5%, because if they did, they would have political and social unrest. The history doesn't look favorably at countries that bring 30 million young men into urban areas and don't have jobs for them. That ends badly. They know that. Okay, Nancy.
Thank you for your remarks this afternoon. You mentioned the average German worker may not be so excited or inclined to support his Greek brother. Number one, what happens if there is a political uprising and they refuse to do it? And then what is the probability of that scenario?
I think it's a low probability. I think if that were to happen, I think Chancellor Merkel signs the law as her last act as the leader of the German Republic. It'll be the last thing she does. It has to be done. If you do the calculation of $2 trillion on the one side, and which, by the way, you wouldn't be writing all of it off. You'd probably be writing off 25% of it, roughly. It's hard to guess that number, but it's not. It's probably $500 billion is the number somebody's going to lose that'll be evaporate somewhere. It's a lot of money, but well, it's that or your economy, right? It's that or your total economy, because the other side is incalculable. It'll be horrifically expensive if it's survivable. There are no legal mechanisms to exit the euro. It's not. It would be messy, ugly, and hugely expensive. I think Merkel signs it and resigns.
I have the mic over here. Thank you. Sir, you mentioned that productivity and profits might be up while employment might be down, if I heard you correctly.
Employment not improving.
Right.
Or very slowly, anyway, yeah.
Can you explain what, if any, effect robotics, automation, and computerization would have on the productivity factor, and if that is, in fact, a factor that impacts jobs?
First of all, it's absolutely a factor that impacts jobs. The robotics issue I'll take aside because I don't know. That's base manufacturing. That's not a huge portion of our overall economy. But if you think about, what technology does just in your job, in your daily life, and even your personal life, how much easier it is to the iPod. I mean, I can even actually use the iPod. I don't need my 16-year-old son to tell me how to use it. And so if you think about kind of the efficiency gains that you get in life through technology, those have been translated phenomenally in the U.S. economy. In fact, worker productivity in the United States has improved at rates that people thought were unsustainable for a very, very long time. And I think you have to look at technology as being the driving force behind that.
Mark?
There's some talk by politicians of the countries of Greece and so on. They don't want to face the public and have them pay taxes. So the alternative is maybe a private answer to that. Sell the taxes due to a private concern who would then collect the taxes and hopefully make a profit on it. Transferring the obligation. No, they're seriously talking about that. That's an old method. It was used in the 12th century. It might work again.
Let's bring back the Knights Templar. It is unlikely that Greece, given left to its own devices, is going to actually collect taxes. They have really no track record of doing that. All right.
Good.
Thank you all very much for your time.
Stop by and let me know what's on your mind. This open invitation from Arizona Congresswoman Gabrielle Giffords captures the very essence of American democracy, a representative of the people seeking opinions from her constituents. It was the last sentence that she sent out on Twitter prior to being gunned down by Jared Loughner, along with 14 other innocent victims who survived the attack, as well as 6 who did not. The little 9-year-old girl there to see how representative government works, the judge, the husband who died protecting his wife, the tragic stories about all the victims we have come to know. The why of their deaths we will never know. Trying to find rational expectations for acts of irrational individuals spirals us into ever-widening circles that progress from frustration to anger to rage. Whereas it would be wrong to attribute any one act to the cause, it would be wrong to say it just happened. The lack of civility witnessed daily among politicians, talk radio hosts, on our highways and roads, and in so many settings where strangers meet with different ideas and different perspectives, is not without consequence. Until we reestablish civility as a code of conduct, whatever peace we may know in our private lives will forever be interrupted by tragic acts such as that which happened in Tucson. It would serve us all well to forgive more, to open more doors for others, to smile more at strangers. For ultimately, it is the build-up of many little things, good or bad, that become the reality of who we are as a community. Which snowflake defines a blizzard? Which ray of sunlight is responsible for melted snow? Building communities, bridging continents, a smile for a stranger. If not us, then who? We're adjourned.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health,